Hi folks, and welcome back to the channel. Today I want to give you a foolproof, guaranteed way to win with money throughout life, divided into 10 easily digestible steps. Yeah, that's right, I said guaranteed. If you're new here, my name is Pete Matthew. I'm a chartered financial planner based in Cornwall in the UK, and I've been putting up content on YouTube for more than 10 years, giving you everything you need to know and everything you need to do to secure your financial future. And really, today's video embodies that. If you only ever watch one video on how to win with money, this is it. Remember, there's a downloadable PDF version of this checklist available from the Meaningful Money website. There's a link in the description below the video. Okay, here we go. Step number 1 is to spend less than you earn. If anybody ever asked me to sum up how to achieve financial success in just one statement, this would be it. Spend less than you earn. Because if you constantly spend more than is coming in, you'll always go backwards. It's just simple maths. Without careful spending control, you will never have anything to put aside for the future. You'll never have any money to pay for insurance to give you a foundation of protection. You'll never have anything. Spending less than you earn means sticking to a budget, and whether you call it a budget or a spending plan or whatever, controlling your expenses requires forethought and planning. It forces you to be intentional about where your money goes. It should be forward-looking, not retrospective. Budgeting happens in the future, not the past. I did an ultimate guide to budgeting last season, which I'll link up here, and I'll also put it in the description below the video. Step number 2 is to pay off bad debt. Maybe before your spending was under control, you've amassed some bad debt like credit cards and overdraft, maybe even payday loans. And as long as this bad debt is hanging over you, you will never be free enough to move forward. Now, the distinction between good and bad debt is simple enough. Bad debt is really high interest and is used to buy stuff which falls in value. Buying a TV on a store card, that's bad debt because store cards usually have double-digit interest rates. TVs are basically worthless the second you get them out of the box. A mortgage, on the other hand, is usually low interest, and houses generally increase in value given enough time, so that makes it good debt. Now, the best method I know to beat debt is called the debt snowball, and that's where you focus on just one outstanding debt while paying minimum payments on all the others. I did an ultimate guide to debt elimination in season 18, and I'll link to that up here now, and again in the description below the video. Step number 3 is to pay yourself first. As well as spending less than you earn, another core principle for financial success is to pay yourself first. You should be your number one priority. So whether you're paying down debt or saving for the future, that should be the first thing you do whenever you get paid. Paying yourself first is a matter of priorities. You gotta save for the future even before you pay your utility bills and you buy food. The first thing that you should use your pay yourself first money for is to put a buffer between you and the world. So you know what I mean. A larger than expected bill for the car service, a mercy dash across the country to help out a loved one, meaning you incur unpaid leave from work and maybe some travel costs, or the laptop that you absolutely have to have for your self-employed work suddenly decides it's not going to turn on one day. That buffer is made up firstly of an emergency fund, and this can start small, maybe just £500 or £1,000, kept in cash in a bank account that you can get if you need it. You can keep it small while you're paying off bad debt. But once you're debt free, you should increase your emergency fund to between 3 and 6 months of your minimum monthly outgoings. And it's hard to overstate just what an incredible feeling of freedom this gives you. Knowing that you could survive if you weren't paid for 3 months, that is just golden. On top of your emergency fund, there is something else that you need to use your pay yourself first money for. And that is to build a foundation of insurance. This is step 4. Build a foundation of insurance in case things go really wrong. We're talking about dying early or being too sick to work for the long term. Having a foundation on which to build means that even if the very worst does happen, your financial plans need not be completely derailed. Now, once your debt is paid off and you've got a decent emergency fund in place, some insurance to protect against the worst that life can throw at you is essential. It should be your top priority. Guess what I'm going to say next? That's right, I did an ultimate guide to wealth protection as well in season 18. I'll link to that up here and in the description below. An emergency fund protects you against short-term stuff. Insurance protects your financial plans against the big stuff that can be lifelong or, worst case, life-ending. Now, the best place I know to get help with insurance is thanks to the good people at LifeSearch. Check them out at meaningfulmoney.tv/lifesearch. Yes, that's an affiliate link, so if you buy insurance through them, Meaningful Money gets a cut of the commission, which helps us to keep going. So thank you very much. Your next job, step 5, is to make a will so that if you're no longer around, your affairs can be dealt with efficiently and that any money that you have, any assets that you have, get to those who need it as quickly as possible. More than half of Brits don't have a will. That's just a travesty. But once it's done, really you only need to review your will if your circumstances change significantly. Like maybe you find a long-term partner or start a family, or if somebody you were going to leave money to annoys you. These days, it's easier than ever to get a will made. I have a deal with FairWill that gets you 20% off the price of a will, plus sends a small commission to Meaningful Money. So head over to meaningfulmoney.tv/FairWill, and thanks again. Step number 6, start a pension. Now that we are bad debt free, we've got an emergency fund in place, and we've got sufficient insurance cover for our situation. What's next? The first thing is to join or to start a pension. If you're employed, chances are you're already in a pension plan. If for some reason you opted out of the pension when you took your job, correct that right now. Join the scheme without delay. Put in at least 3 to 4% of your income, which will attract the minimum employer contribution. If your employer will match more than that, then you try to put in the maximum to attract the extra match. To do anything else is just to leave free money on the table. If you're self-employed, you're starting at a bit of a disadvantage. You get tax relief just the same, but there's no employer to add to the pot for you. So you're going to need to pick a figure that you can afford to put away and make a start. Remember to pay yourself first though. It's too easy to say, well, I'll just wait till the end of the financial year and I'll see what profit I've made, and then I'll work out what to put into my pension. That sounds logical, and in a way it is, but it's not an intentional way to look at things. Instead, you should pay in monthly. It's a great discipline to get into. No one ever regretted putting money into their pension. Believe me, nobody gets to retirement and says, do you know what? I wish I hadn't saved so much money now. Number 7, open a stocks and shares ISA. It's obviously good to have more than one string to your bow. We call this diversification. So as well as a pension, the other main account that you want to open is a stocks and shares ISA. ISA, that's ISA, stands for Individual Savings Account, and it's an account which is always tax-free. There's a limit to how much you can pay in, but it's £20,000 per person per year, which is plenty of headroom, let's face it, for most of us. There are a few different types of ISA, which is quite confusing, but really the only one that's worth considering is the stocks and shares ISA, and also, depending on your circumstances, its very closely related cousin, the stocks and shares lifetime ISA. This latter account gets special treatment. HMRC puts a bonus in for you, and it's designed to help you save towards your first home, or if you don't use it for that, you can use it to save towards retirement. And if you think about it, combined, one person can save up to £20,000 per year into an ISA and £40,000 per year into a pension. Most of us will never get anywhere near saving that amount of money. That's £120,000 a year for a couple. And so for most of us, the pension and an ISA are the only two accounts we'll ever need. Okay, let me just take a few seconds to say thank you to 7 Investment Management who continue to sponsor the Meaningful Money channel. Thank you to them. Definitely check out what they're up to at 7im.co.uk. Now back to the checklist. Number 8, build your portfolio. The accounts, the pension and the ISA, they are just the start. What really matters for your long-term financial success is what's inside those accounts. That is, the assets you buy to make your money grow. Assets are what it's all about. My buddy Andy Hart puts it most succinctly. The most proven way to build wealth is to buy and hold what he calls businesses and bricks. That is, shares in companies and property. Companies and property, businesses and bricks, both those have been proven over decades, centuries even, to rise in value over time. Now hear me here, investing is not about quick wins. Quick wins, where you choose to invest in something and it happens to go stratospheric, those are like gambling wins. Really, they could go either way. You could either do amazingly well or very badly indeed. And we don't want to gamble with our financial future, so instead we invest for the long term. Of course, it's tricky to know where to start, but I've done a whole ton of content on getting started with investing. So start with the ultimate guide to investing. Yes, there it is again. I'll link it up here and go from there. But investing doesn't need to be complicated. In fact, it's better if it isn't. It's about buying lots of different kinds of things all across the world and staying the course. Nearly there now. Step 9 of 10 is to pay off your mortgage. For most of us, the biggest debt we'll ever have is our home mortgage. Now, mortgage interest rates are generally pretty cheap, and especially so in recent years. But I get asked all the time whether it makes sense to pay off a mortgage with interest rates so low. Wouldn't it make more sense to invest for the future instead, where you're likely to get a better return? Now, financially, that's almost certainly the case. But debt, even the good kind, can impose a heavy psychological burden on many people, and the magic of having it paid off is worth more than any investment return. So paying off the mortgage becomes a question of head versus heart, maths versus emotion. Yes, you could make more money by investing any surplus income or capital that you've got rather than overpaying your mortgage. But is that better than the emotional benefit of moving more quickly towards being debt-free? It's a very subjective thing. Only you can decide. Let me also just take a few seconds to tell you about Meaningful Academy, where you can take the things that we're talking about in this video to the next level. It's where I put my most refined, distilled, and most actionable thinking and teaching on this whole subject. There are 2 phases live as I record this video. The first is Financial Foundations, where we can learn about budgeting, debt elimination, and the basics of insurance and investing. Then there's the Build Wealth phase, where we learn about how to build a portfolio, which accounts to open and when, and it gives you access to the incredible Voyant Go financial planning app. There's tons more at Meaningful Academy, so go to the website now and check it out, and maybe I'll see you on the inside. And finally, step number 10, the trick is to take all these things and gradually accelerate them over time. So how do you do that? Well, once you get into the savings habit, try to increase the amount that you save every few months, even if it's only by £10 a month. Try to get your savings rate to a place where it hurts, just slightly. We need to get it to a point where we can feel the pinch of putting money away, but we can still enjoy life in the present. And it's a difficult balance to strike very often, but it's definitely worth finding that sweet spot for yourself. Whenever you get a pay rise or bonus, resist the temptation to just spend all of it. Instead, pay yourself first and identify how much of your new higher monthly income or how much of the bonus you're going to put away for the future and how much you're going to enjoy right now. Waiting until your earnings hit a certain level before you begin saving and investing for the future is a surefire way to make sure that it'll actually never happen. Starting low, maybe just £25 a month in savings and gradually increasing it by £10 a month every few months is a much better approach. Before you know it, you'll get bitten by the bug and you'll start looking for more money that you can invest. It's addictive in a good way. And really, folks, that's all there is to the process of building wealth. Doing so in the way that I've described today is guaranteed to succeed. It's not often you'll hear that in my world, but if you follow these steps consistently over time, you will win with money. Now, notice I didn't say anything about getting financial advice. It's my belief that most people don't need to seek advice. I mean, everybody can benefit from a relationship with a good advisor, but in the accumulation phase of life, when we are building wealth, it's absolutely possible to go it alone if you have the time and the will to learn what it takes. A few comments, as ever, on YouTube. This one is from Chris Dixon, who says, life-changing advice. Thank you very much. Life-changing, Chris. I'm honored. Not sure if I've ever changed anybody's life before, but I'm so glad it was useful. Check out that video. I'll put a link up here on how to make financial decisions. This one is from Odnak, who says, hi Pete, great vid. Thank you. When Bitcoin vid, please. Ah, yes, Bitcoin. Not exactly my specialism, but I am doing some reading and thinking about this, so I'm sure I will be commenting on the whole thing in due course. But I want to come at it from an informed point of view, right? Rather than just throwing some opinions out there. So hold that thought, stay tuned. We'll get to it eventually. Worth saying that Bitcoin isn't an immediate opportunity, right? I don't think it's going anywhere, but don't worry about missing an opportunity. That's not investing, that's short-term quick wins. Could go either way. I'll get a video all about that in due course. And then finally, this one from Maltese Tony. What brand of t-shirt is Pete wearing? Crew Clothing Company, Maltese Tony. About 60% of my wardrobe is made by them. I could generally buy pretty much everything they make. Really good quality and just really accessible and works with slightly chunky fellas. If you're listening, Crew Clothing Company, get in touch. Maybe we could do a deal. Okay, I hope that was helpful. You can download the printable version of the checklist from the Meaningful Money website. There's a link under the video. Check out Meaningful Academy too for distilled and actionable information to help you move forward with your finances quickly. And if this has been helpful, then you know what to do. Hit the like button, subscribe if you're not already, and hit the little bell so that you get a notification whenever we put up a new video. It really helps the channel, so thank you very much. And I'll see you in the next video.